Alrighty, guys, we've got episode 12 here on Off the Sidelines Property Podcast, and we've got our guest on today, Aboho.
Hey guys.
Aboho is the man who puts the A in accounting. He's from KHI Accounting Partners, and I'll get him to tell you a bit about himself.
All right, guys. Thanks very much for having me on. My name is Aboho, as you mentioned a little while ago. I'm part of a group called KHI Group. We're accountants, bookkeepers, solicitors, mortgage brokers, and financial planners. We're based across mainly the Sydney CBD as well as Western Sydney and Southwest Sydney as well.
Yeah.
So I'm an accountant by trade. I'm not sure about the A in accounting, but yeah, that's what we do, and we kind of specialize a little bit on property as well as SME clients.
Yeah.
So that's pretty much a little bit about myself.
And how long have you been doing that for, Aboho?
A couple of years, 8-9 years. Before that, I was in finance, so started off my career in equity research, did a little bit of commercial banking, a little bit of insolvency work somewhere in there as well. So yeah, it's. I'm a tax accountant now. Yeah.
Beautiful. So quite diverse in that industry.
Yeah,
Nice.
yeah. It's helped me, if anything, just to understand a whole bunch of kind of facets of understanding how industries run and how people run and how to relate to clients, I suppose. Yeah.
Yeah,
perfect.
okay, awesome. And Aboho, is there a particular field that you specialize in? I know you mentioned property, but is there a certain state? Are you restricted to a certain state, or is it a one size meets all?
It's not potentially a one size meets all. I've actually tried quite deliberately to be a generalist all my life.
Yep.
It's not a one size fits all because every person has got its different kind of backgrounds and I suppose requirements as well. But being a generalist, I understand how to relate those different sets of backgrounds and requirements to, I suppose, better help the client.
Sure.
So am I a specialist in tax? No. I am a tax accountant, but there are tax lawyers above that who specialize really quite intently into it.
Yeah.
But yeah, tax accounting is what pays the bills, but
sure.
it's probably a percentage of what we do. What we do in a wider scope is probably, for lack of a better term, we're more of an advisor.
Yeah.
And that's what we really do. Yeah.
Okay. Oh, awesome. And could you just give us an overview about the, I guess, tax code regarding property? So if someone was to come to you and they're I guess, a PAYG employee, and they wanted to get their taxes sorted,
Yep.
what does that process look like?
Sure. Look, there's a couple of ways to. I know it's a fairly generic, I suppose, example, but there's a couple of things we have to go over there, right? So first of all, we look at that PAYG. We ask a couple of basic questions to start off. We ask, okay, what's your gross income? Do you have a spouse? Do you have a dependent? What kind of goals and objectives do you have? And all of that kind of ties into the fact that, okay, yes, this is a bit of a tax planning session,
Yep.
but I'm also a bit of a scorekeeper as such, right?
Okay.
So I give them a 5-10 year plan. What are your goals and objectives, and how do I get you there? So the tax side is quite, I suppose, depending on who it is what deductions, what they're working from home, did they use a car that they weren't remunerated for, are they on some sort of novated lease, in which case they can't claim those deductions, do they have investment properties, what are their assets and liabilities look like? Quite often the answer is not necessarily getting them the best tax deduction.
Why is that?
Because when you say best tax deduction, quite often in people's mentality, they're like, I want to claim everything,
Yeah.
which often, first of all, is probably not allowed.
Yeah.
And two, I want, once a client comes in, my idea is solely, okay, how do I improve his life? Do I make it transactional, where I just, okay, you give me $99 or whatever it is, go to H&R Block, they'll do a better job. That's not what I do. My idea is to build them up in life. Right. So if I claim X, Y, and Z that they want me to claim, will that look good on a mortgage application?
Right.
Yeah. Would that look good 5 years from now, when he wants to get into that property, or next year when he wants to get into that property, or he wants to make X, Y, and Z investments. So it's something that you have to take a little bit of a broader view of who that person is. That's why we generally, again, like I said, it's not transactional. We sit with the client at least twice a year, if not more. They call us however many times they have to, because it's a process of understanding where the gentleman is and where, or gentlewoman is, and where they want to be in life. And how do I figure out, and that might be obvious to some people. It's not obvious to other people.
Right.
And it's kind of translating whatever knowledge that I have, as it may be, to help that person go along in that journey. So that's, I don't know if I answered your question.
Yeah, no, that's great to start off with. But then I guess, all right, if you can break down what kind of clients you typically serve, then I guess we can kind of get into the creative ways in which you help people file their tax returns.
Right.
Yeah.
Okay, so again, there is no one size fits all. So I have anywhere but to retail investors, 1 to 2 properties, all the way from corporations that are $5+ million as well.
I get that. So our target, well, not target market, but our demographic really is the layman or young families, people that are up and coming.
Absolutely.
So,
and and keeping in mind that is probably where the passion lies, which is how do I build them up, which is a little bit more better than just that transactional work. Okay, so let's say it's a gentleman and a gentlewoman who comes in. He's got one property. He wants to get into his next one. Okay, what can he claim? On a PAYG income, there's only so many deductions you can claim. You can claim a bit of work from home, a little bit of travel deductions. Maybe if he's on a path to increasing his knowledge base, maybe some of the self-educations I can claim as well. Within the property itself, it'll depend whether the gentleman's done a depreciation report. I can claim the depreciation, the usual interest rates, council rates, water rates, so on and so forth. Insurance that he's paid for the properties as well. All of that's claimable. I suppose the nitty gritty of it is things change, and the tax code is a very fast moving environment, right?
For sure.
So if I sit here and I tell you, I list down all the deductions that a person can take, probably not the best serving, but there is quite a bit you can claim. Now, when the gentleman comes in, again, the idea is, of course, we shouldn't pay more tax than we need to.
Of course.
That goes without saying. That the idea would be, okay, sit down, what's your assets and liabilities? Here's your deductions, that's all good. But where to next? How much equity is there in your property, right? Now, I'm not a financial planner. I don't give financial advice, but at the very least, I can give a certain level of checks and balances to see, okay, how far along in your journey are you? So that's probably, if I'm in a long-winded way to answer your question, the tax part we get done before June. We look at what deductions we can make.
For sure.
Perhaps we can do a little bit more personal contributions into your super fund. Claim that as a deduction. And why that's important is at a stage, if your super balance is large enough, you can potentially shift that to a self-managed super. And go for a limited recourse borrowing arrangement to buy a property as such, right?
For sure.
Now, if you are claiming that extra superannuation deduction, whilst you're claiming it under your personal tax returns, it's being taxed under your super fund at only 15%. So there's a bit of advantage over there to be had as well. So all of that, I mean, we can get into the weeds, and it keeps on getting more and more complicated. But the idea being, in a very generic term, is you don't pay more tax than you absolutely must. We make sure of that. Yep. But the role is, where are you going to go in 10 years from now, 5 years from now, 2 years from now? And being that scorekeeper and looking at their assets and liabilities and pointing out perhaps what's not obvious or opportunities that are there that perhaps they have not taken.
That's awesome.
So what you're saying is, instead of setting them up to get like 10 grand back this year, you'll set up a 5 or a 10 year strategy to make it effective as long as possible.
Yeah. That's part of it, and it's also understanding what the person wants really. And we always start with this: what are your dreams? How big are your dreams, right? And what can we do to get to your dreams and make that an actuality?
Yeah.
And in terms of like people, like I think a lot of people just think tax time, 1st of July, go do your tax and things like that. Do you suggest people should reach out to you 3 months, 6 months, 4? When should they start looking at getting their tax ready?
Look, again, for our clients, at a bare minimum, we sit down twice a year, right?
Okay.
So we sit down before the tax year is done, which is before June 30th, because after June 30th, it's too late. I can't do anything. So we look at the position there, and we look at different strategies to see what we can do, what we can't do. Once that's done and that bit of tax planning meeting is done, of course, we come probably towards the beginning of August. That's where the SDP with the ATO is finalized as such, and all of the workings behind what goes into the tax return are finalized. So probably early August is the second time we go around. But that meeting is partly to do with, okay, we've done your tax and this is your result, but partly to also do with, okay, where to from here? So both meetings are, for us, quite important. It's a working relationship, right? Like, and the more they come to us, and the more we do not in any way discourage for them to call us multiple times a year.
For sure.
The more they come to us, the more value we can provide to them, and that's what it's about, really. Yeah.
Okay, I like that. And Boho, in terms of tax laws, from what I've kind of noticed, that there has been a lot of changes. What's your take on certain changes? I know that Queensland have kind of changed their land tax rulings. If you can give us a brief highlight of what your thoughts are regarding Queensland land tax, and I guess I think Victoria also they've got a few changes there. So would you say that these are for property investors, or is it working against them? Yes, no, maybe. What's your kind of general
That's
view?
a very good question. It's a very, very good question. Look, without taking sides, obviously, what I think, and this is again what I would think, and by no means what is probably going to happen. Queensland has introduced that into legislation where they're decreasing the land tax threshold. So essentially, anybody with properties outside Queensland will have their land tax threshold decrease and pay land tax in Queensland. I think probably all the other states, once they recognize the gold mine that it is, probably will follow suit. And that's on an individual basis. Of course, under a trust, it's different.
Correct.
But I think in the short term, property investors potentially might, I suppose, shy away from Queensland for a little bit because of this. Not because of anything else. I mean, it'll normalize over time, but I think the initial hit would be like, oh, okay, I don't like that.
Yeah.
I don't want to potentially go somewhere where I'm paying a little bit more in land tax, and I don't know what the market holds for me in the short to medium term. Yeah. So that's what I personally think. Doesn't mean that's what's going to happen, but to summarize, I believe the other states will follow.
Yeah.
And Queensland in the short to medium term may potentially take a little bit of a hit.
Yeah. Okay.
And is there a figure for the land tax amount in Queensland they're looking at?
I'd have to check those numbers to come back to you.
But it seems like it's a lot less than it used to be. Yeah. So it's going to be.
Look, coming back to, I suppose, what's driving it is the government needs money, right? It's gone on an expansionary monetary policy for the better part of 20 years.
Yeah.
They're going for infrastructure improvements and all of that. All of that costs money. The states need money. Money's got to come from somewhere. And revenue would potentially come through land tax, payroll tax. What the governments are doing with payroll tax nowadays is also quite aggressive, in my opinion.
And I guess they've got the Olympics coming up too.
Yeah, in Queensland, yeah.
And the Redcliffe Dolphins need a stadium. They're coming out next year as well. So all happening up there, yeah. Absolutely. And I guess a question a lot of people ask as well is, and it's probably a two-part question, positive gearing versus negative gearing. And what's the difference and what should people do? I guess that's based on their situation predominantly. But in general, could you just give like a high level of view of the difference between sort of positive and negative gearing? Because I think people unpack that differently.
Yeah.
They've heard from their uncle at a barbecue or something that positive gearing's great because their friend did it in the 70s or 80s. But I feel now like a lot of people still really don't understand the difference.
Yeah. Good question. So if we unpack that into two levels without using all the technical jargon, let's remove the word gearing from it, right? At any point of time, I want to have a positive cash flow property, i.e., whatever rent is coming in should be higher than whatever expenses I'm going out on a cash basis, right?
For sure.
Okay. The negative gearing side only becomes interesting when you claim something that's called depreciation, which is a non-cash expense. So you would go to a quantity surveyor like Duotax or BMT or Washington Brown, and they would do a depreciation report for you. And within that schedule is detailed what you can claim and what you can't claim in depreciation over the next 20, 30 years. That gives a tax benefit because you aren't paying that, I suppose you're not paying that out in cash. So that's called negative gearing as such. That's very desirable, obviously, because you're getting a tax advantage without paying it out in cash.
Yeah.
Where it gets a little bit hairy sometimes is depending on your strategy again. People sometimes buy negatively geared properties on a cash basis as well because they think it'll help their tax. But the concept to understand is if you've lost cash, that means you're getting back, let's say, 30 to 32 cents from the government, but you've lost out that 70 cents. As opposed to, let's say even if it was positively geared, I'm only paying 30 cents out of that dollar. I'm still making 70 cents of come out on top.
You're not losing that.
Yeah, so that's potentially the concept and I know this concept's been hashed and rehashed over the internet, right?
For sure. Oh, absolutely.
But yeah. So that's probably what I would say to the retail investor as such.
Yeah, absolutely.
Yeah.
So just to go over that, you're better off purchasing a property just in terms of cash flow.
Yep.
You're better off being positively, not necessarily positively geared.
Positive cash flow, yeah.
Exactly right, because there's a clear difference, right? And I think would you say that the gearing comes into effect after your tax and all that has been kind of calculated, or where does that gearing or that terminology stem from?
Yeah. So first of all, to caveat everything, I'm not
It's
a
not financial
yet. But
neither are we. So it's all for education, guys.
In my opinion, cash flow is one of the indicators. Yeah.
Yeah.
One of the major other indicators is potentially what the capital gains will be, right?
Okay.
So if it is, let's say, and I'm going to give a very generic example, it is a house with a large piece of land attached to it.
Yeah.
That is, let's say, for argument's sake, neutrally geared, which is I'm not making money, I'm not losing money.
Yeah.
Or if it's even slightly, I'm losing a little bit of money, I wouldn't mind it if it was in a good suburb and it had potential for growth, potential for multiplication of cash flows by manufacturing growth, by putting granny flat in the back or subdividing or whatever it is, right?
Yeah.
So that's probably the investment side of it, which should be tantamount. The tax comes later, right? The tax is a bit of a, I suppose, icing on top of the cake, right? So we should never go towards property thinking about the tax benefits of it. That's what I think.
For sure.
Now, personally, again, other people might think differently. The investment in a property should be based on the merits of that property alone. Now, positive cash flow is great, right? But you could also get positive cash flow on apartments, and apartments may not get that level of capital growth that houses do, or townhouses, or so. Again, a whole bunch of different factors that come into it, and it should be judged on the merits of that case alone, not necessarily what tax benefits. Tax, again, it's good to get some money back from the government, but not necessarily. It probably shouldn't be the strategy to buy that property.
And that's a really good point. Like I think like what we try and do for a lot of our clients is look at what's obviously got a good yield, but also a good growth as well.
Yep.
Because you can't have crazy yield because then you're going to have low growth. You need to find that medium point.
Absolutely,
where you've got good yield and good growth. But also, if people are worried about having too much income and positive gear, that's a good point. They can sit on something like a house with a big block of land. They can be neutrally or a little bit negative. And down the track, they can create wealth through developments, granny flats, duplexes, and things like that. So that's a really good point.
Yeah. That, for example, like if you look at commercial real estate, right? they generally have higher yields, right?
Yep.
Correct.
But again, the capital growth is quite minimal.
Yeah.
Now there is an argument to say that high yields sometimes attract a lot of a demand towards certain regions, and then that pushes up the price. There is an argument for that, but in general, what I would do is potentially judge it on the merits of that particular investment. Like you said, get something that'll have both the cash flow over time as well as the capital growth, that's probably the meat of what we're seeking. Is if you look at yields on houses, they're like 4.5%, 5%, maybe 6%. For a leveraged deal, that's not tons of money, right?
Yeah.
But the capital growth on that is quite significant. I mean, depending on the property, obviously, but the capital growth on that probably will overshadow that 5-6% yield, and that's what we're going for. So again, a whole bunch of different factors that you need to seek investment advice. But yeah, there's a couple of things that you might potentially want to look at.
Yeah. Okay. Perfect. Awesome.
Yeah, brilliant. And in terms of like what we were talking about earlier in this land tax, I think that if governments are going to be, and this is just my opinion, but I think there's obviously a reason that they're putting a tax on it, as you said earlier, because everyone's going there. There's a lot of growth. It's a revenue raiser for the government and things like that. So what does that tell investors? Yeah, you might have to pay a little bit more, but there's could potentially be a lot of growth.
Absolutely.
Your return's going to succeed that little bit of land tax that you're going to pay. So I guess we've just got to look into that into the future and see if that's going to be worth it.
Yeah. Well, another theory to add to Dan's point, another theory that I've kind of heard is they're trying to preserve the state for Queenslanders and give the populace a property buying opportunity, because what happens is if investors are savvy, they come up, buy up blocks, chop up blocks. Mums and dads, the laymen can't really afford to purchase property, and obviously what happened with COVID too, people are moving towards Queensland because it's more desirable, it's more affordable, it has that lifestyle, you're close to the beaches and all that kind of stuff. So it is attractive, but the people of Queensland aren't getting that opportunity to kind of achieve the great Australian dream, if you will. So that's one theory, and it kind of makes sense from that standpoint. But again, with all this, inflation and monetary policy, and the debt that we've currently got as a country, as an economy, then I guess by all means, you've got to make money through whatever means possible if you're a government. So what's your take on that?
A lot to unpack there. There's a lot of different theories of that. Okay. Let's take it from the position of an investor, yeah?
For sure.
Look, the government's going to do what they're going to do, right?
Exactly.
It's probably little control that we'll have over it. As an investor, there is two ways of looking at it, right? One is if you already hold existing properties, potentially because of the raise in interest rates over time, we might see a bit of a fall in that. No reason to panic.
Yeah.
Again, like I keep saying, property is a long-term game. You cannot just look at it in a particular period of time, right? The other way to look at it is probably a really good opportunity for investors. With the government's monetary policy, and if you've looked at the latest statement of monetary policy from the central bank, the language is kind of softened a little bit, which tells me that, I assume, again, this is based on my assumption, my thought, and that probably between the periods of November and March, the monetary policy will soften a little bit. And part of it is to do with Christmas, part of it is to do with that the central bank doesn't sit in January. The other part of it is what I take from the language of it is probably going to soften the stance towards the 2024 year. But at the same time, I believe the pain will already flow through to the market, which means there's a lot of opportunities to be had in the market. So if you can, this will probably be a good time for you to, I suppose, build up your reserves, your cash reserves, do what you need to do to potentially look into investing into properties during that November to March period. Now, of course, don't just buy for the sake of buying, right?
Yeah.
But what I am saying is there will be opportunities in the market. If this current state of things go, I expect people to the pain to flow through to the market and some opportunities to be had. So as an investor, you got to think in a bit of a contrarian way, which is whenever everybody's saying doom and gloom, you got to look at the opportunity side of it.
100%.
And whenever everybody, including your Uber driver, is saying, "Oh, the market's going up, it's amazing," that's the time to be scared, right? So I don't know if I've answered your question, but in there somewhere, I feel like the answer is there. As an investor, be contrarian, move the opposite way where people are going. That's how the biggest investors make their cash, because they find new ideas where people aren't even looking. So yeah, that was my.
And that's a really good point as well, Baho. Like, Ernest and I have noticed, recently as well, like in the last few weeks alone, people are really scared from a selling perspective. And like 6 to 12 months ago, we'd throw some offers out where people would laugh at us and hang up the phone sort of thing. And now we're throwing these offers out and they're like, well, let me have a chat with my vendor. I think they're very motivated to sell. And I'm like, motivated to sell for 50 grand less? I haven't heard that in 2 years, maybe 3. So now we're starting to notice that. And now we're putting in some of these offers and, 50K to 100K off at the moment. And people are saying, there's going to be a drop. But if you're looking at a 600K property with a 50 to 100K, there's already a 10 to 20% getting it now. So you sit onto that, get a really high rent because your yield's great because the rental yield vacancy's at 0.2%, build up some more equity, pay it down, and then go again.
Absolutely. And just wait it out. That's the thing.
Absolutely.
The biggest thing that I feel like in the property game, a lot of people get nervous about is the timing of it. Just wait it out.
Absolutely.
Baho, I want to get philosophical here.
Absolutely.
And,
love philosophy.
And I want to kind of get or understand your notion on time and time horizons pertaining to investments, of course, because there are people that can be quite impatient. So what's your advice or what kind of concept do you kind of adhere to when you invest?
Seek advice from a financial planner. Okay. Besides that, look, time, again, like most things, it's relative, right?
Yeah.
When I use the word impatient, I do that with all due respect. There is no one set rule for anything. Yeah, do what's right for you, whatever you think is right. I'm a first generation immigrant, and I've got a very simple policy. Just keep running. Just keep running, right? We don't worry about the numbers so much, right? Unless we have some level of requirement or some need for that cash, I don't really look at the results on a day-to-day basis or a monthly basis. I look at it over time. The concept of compounding interest is very, very important. And whoever's listening to this podcast, do a little bit of research. Any investor worth their salt, they put a high value on compounding interest. And that only takes effect if you don't mess with something too much. Just leave it there. Just wait for it to do its thing. And if you keep adding to it over time, it builds and builds on that base. And that's potentially something that I would give as an answer to that. Believe in the power of compounding interest. The only way you get over impatience is to see, okay, maybe the target's not 5 to 10 years. Maybe the target's 20 years. Do I really need the target to be next year? And if I do, why is that, right? And people need to have an honest conversation with themselves is, okay, why do I need to see 100% gain in my property next year, right? It's nice to have, but does it really need to happen? What am I doing in the meantime to increase the wealth, right? So we keep working at it. We keep putting a little bit away and believe in the power of compounding interest. That's it.
I like that. That's a great response.
Yeah. what's it?
I was going to say
Long-winded as it was.
And then that
I
comes
couldn't
down.
have said it better myself.
Yeah.
And then that comes down to the saying, like, you're so much better spending time in the market than trying to time the market.
Correct. Yeah.
Because you're just trying to chase your tail.
Yeah, it's. I don't want to say the word impossible because I don't want to use that terminology, but it's very, very hard to time the market.
Oh, yeah.
People spend, like you've got the Goldman Sachs spending hundreds of millions of dollars and still they get it wrong most of the time. So it's not easy to time the market. So why should you feel like you're better than them, right? So just wait it out, time in the market versus timing the market. That's the usual adage. Just compounding interest. Wait for
That's
it.
awesome,
Yeah,
guys.
Perfect.
Have you got anything else you want to talk about, Otis?
No, Abajo, you've been
Yeah,
amazing.
thanks so much for having me,
Daniel,
guys.
thanks for having us again.
Anytime. Thanks,
been
guys.
great.
Love your work.
It's a great
Thanks,
episode.
Abajo.
Thank you.
Appreciate you coming on.
Yeah.
Thanks, Onus, the co-host.
Awesome.
Yeah,
That's a wrap.
Thanks.